crisis doesn't make a person, it just reveals what a market is made up of. On that note, welcome to our Zoom web series hosted by One Tree Hill and PMS Cart. This is on the Juggernaut, conversations with uncommon and curious fund managers. Hi everyone, my name is Jai Shah and I have with me today Abhay Agarwal, who is the fund manager managing the Piper Serica PMS and the Piper Serica India Numero Uno fund based out of Mauritius. Prior to this, he's worked at JP Private Equity based out of India, Hong Kong, and Singapore. Welcome, Abhay, to our show. And one of the things that we sort of like to get started with and, dive into is what we call the machine gun 15, right? It's a quick fire round of 15 really confusing and difficult questions.
Sure,
But
I'll try to do my best.
super. That's what we like to hear, right? And hopefully you'll get through and win a coffee with Karan Hamper at the end of the day.
Nice. Okay.
Perfect. Ready?
Sure, go ahead.
Okay, perfect. How long will India remain an emerging market?
I think another 10 years.
Another 10 years. Okay. The biggest red flag that you look for in stocks apart from corporate governance?
The biggest red flags?
Yeah. That you look for in a corporate apart from corporate governance in a stock?
We look at the background of the key management team. Where have they worked earlier? Where have they come from? What was their track record? Are there any red flags? When we diligence their background, we try to understand from their ex-colleagues whether anything that stood out in their past conduct or record.
Okay, interesting. Will oil go back to zero again, below zero again?
Now, it may sporadically because, just because the world doesn't need the oil that's being produced, but I think it may happen for maybe a month or so more because a lot of companies will just stop producing oil. So this whole problem of storage of oil will anyway dial down.
So any chance that I can go to the petrol pump and they'll pay me to fill my car?
You can fill your whole house with oil drums right now.
Perfect. Then the question which is on everyone's mind, are we at the bottom?
I don't think we are at the bottom. Bottom is probably closer to 8,200, 8,300 as per our numbers. But we don't know whether we'll get there or this flow of liquidity that is going to come in is going to keep us away from a bottom, because from now here on is going to be a liquidity driven market, not really fundamental driven market.
Sure. And when do you think that changes?
I think for this current quarter that we are in is going to be a washout. All companies are anyway guiding for it. So, investors would kind of erase this current quarter. They're going to look at Q3 to come up with next 12-month earning target and next 24-month earning target. So depending on how those earnings pan out, people will start looking at value in stocks.
Okay, fair enough. Which balance sheet is the most stretched? Is it the government, is it the corporate, or is it the individual?
See, government balance sheet is always stretched. I mean, that is the nature of the balance sheet because, the more they stretch, the more they can stretch it, they stretch it. In fact, now is the time they get an opportunity to stretch it even more, so it has to be stretched by design. So nobody can compete with the government balance sheets.
Fair enough. And increasing stress or lower stress in the corporate and the individual balance sheets?
So I think the large companies with strong balance sheet will get stronger. The weaker guys who were skating on very thin ice with very weak cash flows prior to this COVID-19 will have a very tough time. In fact, I'm expecting that even in medium-sized companies, a lot of listed companies, there will be bankruptcies. There will be companies that will just fold up. And same goes for individuals who are sitting on a lot of debt, not able to repay it.
Next one, top down or bottom up?
No, we are completely top down. We have, all of us in our prior life in some form or fashion tried bottom up, but we realized that, you really can't, you can do it as an individual, but you can't manage other people's money doing bottom up because there are just way too many risks. So we are a complete top down fund, and that's the way we want to be.
Fair enough. What percentage of the times do you think you are right in the market in all your sort of experience? What has been that ratio?
So I think it's 100%. My team thinks it's 10%. My investors think it's 2%.
Yeah, exactly. I don't think anyone cares about what you think or what your team thinks. But in general, what would be a number that you would be comfortable saying?
So I think we have beaten the market handsomely over a period of time. So there is some method to the madness. I don't know how many times we have been right, but I think the process we follow discipline. I think we are more right than wrong, I would say.
Okay, fair enough.
But that edge maybe, even if it's a 1% edge, even if you're right 51% of time, believe me, if you do it for many long years, it makes a big difference.
It all adds up. Absolutely. One aspect that no one knows about you, or very few people rather.
That's a tough one. Okay, so there you got me. And you want me to tell you right now?
Yeah, absolutely. It's the machine gun 10.
Okay, so I would say, yeah, I mean, one deep desire I have, and hopefully I will fulfill it sometime, is to represent India in my, the sport I'm passionate about, which is judo. So there is a veteran circuit which is quite, popular globally, and I hope to represent India at some point of time. So that's the dream I have. Hopefully, will come true at some point of time.
Excellent. On to the next one. Where do you see the next big innovation?
So I think that's a very good question, because I think people are going to refocus on innovation and funding of innovation. For last 30 years, all we have invented, frankly, is internet and gadgets and apps. And now we are realizing that there is very, very little marginal utility of more of that innovation. What is the point of having a faster network or a speedier gadget or a cool app? Uh, when everybody is locked down. So I think there is going to be tremendous innovation on the life sciences side. A lot of scientists will get funding now to come up with drugs. This is not the first epidemic. This will not be the last epidemic. We don't know where the next one is already getting created. So I think there will be a lot of innovation in the healthcare, life sciences. We will see new ways of fighting old diseases, new diseases. So I'm very hopeful that that is one space globally, and in India also, hopefully we'll see a lot of money backing innovation, because innovation needs to be supported by funds, and funds come in when when investors see a positive outcome. So I think that is what is going to happen now.
Okay, super. What is one thing that you feel that most investors get wrong or have a misconception about?
I think so I've seen this, across the board, and I check myself also many times, and my team also. We all want to be long-term investors. We all want to be long-term money, and then we look at daily NAV and weekly NAV, and try to change our tactics and portfolios and rebalance dynamically. Oil falls down to zero. Everybody wants to buy oil. So I think that is where people get it wrong. That they have long-term aspirations, but they act in a short-term way.
Okay, fair enough. Diversification in equities or concentration in equities?
I think as you mature, portfolios automatically start getting concentrated. So if you start getting more confidence, your research quality improves. You will see that as people get older, the fund managers who have been around, seen market cycles, they will have more and more concentrated portfolios. So people when they start investing, they have portfolios of 40 companies, 50 companies. 10 years later, they have 25, and then when you're 55, 60, people have, 10 stocks, because then you realize that once you know something well enough, might as well go with it, because over diversification, frankly, at some point of time starts eating into your returns rather than reducing risk.
Fair enough. Perfect. Would you double down or double up?
We don't really have a strategy for that. So if we have a stock that is doing very well, we have no problem buying it as it goes higher. At the same time, we have had situations where we bought a stock, it went down, and we exited rather than averaging down, because we lost faith in the company and business model.
Okay, fair enough. And as a person, are you an optimist, pessimist, or a realist?
I'm a realist. I'm a complete realist, and that's what I want to be. I think all investors should be realists. They should not be either optimists or pessimists.
Okay, fair enough. And sort of the last one, which might put you in a spot, but how would you rate the research on the street from a scale of 1 to 10? 1 being the lowest and 10 being the highest.
No, I would say it's very, very poor.
Okay.
People who are doing research are not spending enough time on the field. We meet a lot of analysts who have gone to management meetings, looked at comms, done some analysis, and they're already working back with a certain outcome in mind. But there is no, all I want to see as a manager is give me 2.3 point investment thesis, then I'll work my way from there. And that doesn't happen. I think it just gets lost in too much of content.
Sure, sure. Fair enough. So done with the machine gun 10. I think you won.
Ah,
And
good, thank you. I look forward to getting my
your
hamper.
hamper your hamper should be on the way as soon as the lockdown ends.
Okay, great, thank you.
Whenever that is. And on the lockdown issue, what do you think this lockdown is going to, we talk about prices, but there's so many theories about how this lockdown will behave. Where do you think the lockdown is headed?
I think I don't think the government has an option that to open it up gradually and slowly in a completely, even if there are spike in cases, because there is very soon and it's already building up a big resentment from people who want to get on with their life. And I'm not talking about people like you and me. It's more people who need to earn money on a daily basis to feed their family. I mean,
Sure.
forget saving. These guys are now going to struggle. And how much can they live on charity? How much can charity support them? At some point of time, they're going to say that, look, anyways, in India, 20,000 people die every day. You
Right.
know, that is the rate of death in India, natural death. And then out of that, 1100 or 1200 die every day of tuberculosis. Now, if 50 are dying, or 100 are dying, or 1,000 are dying of coronavirus, I think the government will have to take a view and say, look, let it play out by itself. There are some areas like Maharashtra, some states which are hotspots. Let us not open those up.
Sure. Sure. Fair enough. Now moving on to sort of Piper Serica, and my organization is named after a trek in Mathiran, right? Piper Serica is a very unusual name. Where did it come from?
So when we started this fund long back, we wanted to do a China-India fund. Uh, so my partner in Singapore, he came up with this name Piper Serica. Piper means pepper and Serica means silk in Roman. So we said, pepper will represent India, silk will represent China.
And when was your sort of first interaction with the stock market?
I did my BCom from Sydenham College. And Sydenham College is a place which is infested, or at least that point of time, infested with stockbroker children or people who work for sub-brokers or were sub-brokers. So half of my class was, bunking college and hanging around Dalal Street.
Sure.
And it was quite natural for me, tag along with them. And that time, I'm talking about, late 80s, early 90s, Harshad Mehta time. It was like, the big deal to be around the stock market, and you were a celebrity if you understood what Badla meant, and
Sure.
how stock are traded, and you could calculate the stamp duty value of putting stamps behind a transfer certificate. All those were like really cool stuff.
And now coming to your PMS, I think you guys had a great last year, relatively compared to your peers and the benchmark. If I had to pinpoint and ask you, what is that edge and that USB that contributed to this success?
Yeah, that's a good question. I'm glad you asked me. So in the investment process that we have breaks up into four parts. One is that where we identify industries which we think will grow in the country over next 15, 20 years. Because we don't want to go against the tide. We say, these are because of the demographic changes, way people are consuming stuff. There are certain industries, you look at global peers like China, Thailand, countries, US, and say these are the industries that have to grow in India, like healthcare, insurance, financial services, entertainment.
Sure.
And once we have this list of industries, what we do is we look at the number one company. The number one means clear market share leader. And then we run that company through Michael Porter's five forces competitive edge model that we have converted into a proprietary model with some changes, where we rate each of these companies on 35 parameters to figure out how competitive they are, and we score them on a table of 1:10, 10 being strongest. So we meet the company's management, we meet their competitors, we meet employees, ex-employees, suppliers, their distributors, bankers. We do full 360-degree research, because unless we do that, we cannot complete the model. We cannot score. And there are a lot of times when we don't get data, we get stuck, we keep looking. So to complete this exercise, we have to know the company very well. Only when the score is above 7, the company becomes investable. Sure. And then once we have identified the company that we want to invest in, only then we look at valuation. So we have our proprietary valuation models that we run to figure out what is a fair value range. We don't come up with a number, one number. We say the valuation range is, let's say, from 1200 to 1800. If the stock goes to 1800, I'll trim it down. If it is at 1200, I'll add more.
Okay.
And then lastly, we have the process of allocation and risk management, where we don't want one company to be more than 7% of the portfolio. So this is a 4-step process that we follow. And our research is a lot of primary research, channel checks. We know the distributors, we know a lot of suppliers, we know a lot of people on the street, through which we get real-time data, which I think really helps us. We don't rely on analyst reports as much. So following this process very regularly on a daily basis, we don't really have too many team meetings, because we don't track so many companies. Our universe is about 40 companies. Each portfolio has about 18 to 20 stocks at any point of time. So really, we're not spreading ourselves too thin. We don't want to be mile wide and inch deep. In fact, we want to be just an inch wide, cover very few companies, but know pretty much everything about them.
Fair enough. And because becomes a concentration, sometimes the questions that do come up is that what is the general holding period that you would expect from this portfolio? Or if I could twist it the other way, what is the shortest time that you held a stock?
Well, the shortest time was just last year. We bought this stock called HDFC AMC in June at 1600, and I think December we exited it. It went up to 3700, which we thought was just crazy valuation. So I think the company is very good. It is a number one company, has very rock solid flows, but that was purely a valuation call. Otherwise, we don't really exit companies as long as they are compounding earnings. But what happens also, Jay, in a very volatile market, the prices spike at times to unreasonable levels. So we use that opportunity to trim our positions. Sometimes the business models are broken. So, for instance, we exited, we didn't want to, we think PVR, Phoenix Mills, Interglobe, Godrej Property, these are great companies. But we exited each one of them in February and March when we saw the onset of COVID-19, because we realized that is going to really destroy a lot of value, even in the short term, for these companies. We would like to hold stocks forever, like HDFC Bank, HDFC Limited. They have corrected, we've added more. We'll keep adding, because we think that the management of these companies really get core business.
Okay. Attention to what we just talked about is that, look, if we are following a process and have certain rules around it, does it actually have a lifespan, right? Or will the algos at some point understand what Abhay is trying to do and, take over your strategies in a way and try and sort of, make you redundant?
I think we are headed that way. I think another 10, 15 years, because, for instance, my son is 17 years old, 18 years old. He's just, preparing for engineering. He wants to do software coding. I don't see him sitting next to me and doing this thing manually. He'll look at the process and he'll say, look, I can code this.
Sure.
You have this process of looking at top companies, you do their scoring. I'll take some data from somewhere and I will come up with an algo, and it will tell me the Porter model score. It will do the allocation for me. It will tell me when to exit something. Maybe there is some manual intervention. So for that, I will retain an old guy like you to help me. But rest of the stuff.
I'm not old. I'm sorry. I'm not old.
No, old like me. I'm saying that my son will tell me that you're a good guy, so I'll keep you employed, for the time being, because there is some 1% maybe gray hair oversight required. But other than that, I don't need this. I'm a single. So to answer your question, I think a lot of these rule-based things are headed that way. And what we see, complete passive investing, this rule base will also get into that. Maybe 5 years later, 10 years later, it will start happening. People will see success. And then what will happen is that the other active management part, which is pure stock picking, that will become completely unfashionable, because that will be seen as a very risky and unnecessary and inefficient activity.
Got it. Got it. Okay. One of the things that we've seen is that, most fund managers like to say that, look, I am a buffet style fund manager, or I am a Greenspan fan, or I'm X, Y, and Z. In your mind, have you come across, books or investors which have been overhyped and saying that, look, in your opinion, this thing doesn't work actually. It's just great sales.
Yeah, I think one book which I have never been able to complete, and I think is very overhyped, is this Security Analysis by Ben Graham.
Okay.
I think that book belongs to a different era when things were different, and you can't read it and apply. Maybe some concepts you can apply, but those you can learn. You don't have to read a 800-page book which kind of reprints every year with new forewords. So I think that is a very overhyped book. And I think in every investors have their styles, and a lot of them are very successful. But blindly following them may only be, you may be only following 10-20% of what they know or what they do. So I think it's a recipe for disaster. Most of the times you're better off doing your own work, own research, coming up with your own strategy. The good thing is that, there are so many strategies that can work in this market. It's not a zero-sum game.
Right. And based on the zero-sum game, do you see, while everyone might not get everything right, everyone is trying to figure out what is the next big trend, right? Do you see any disturbing trends in our market right now?
You're talking about the stock market or the companies, or
the stock market in general?
Yeah, I think one thing which I think there is just too much of this social media and financial media and two-bit news and two-bit opinions which are floating around.
Sure.
I see a lot of our investors, and these guys are rich guys, very wealthy, run very good businesses. But I'm just surprised at times what they read something on Twitter, or they get a WhatsApp forward and they start either worrying or panicking, and then they want to have a discussion. It's just painful. So I think what is this whole reduction of attention span of investors, of reacting to every small bit of news, which may be, 99% is completely useless and corrected by time, very quickly. There's no point. So I think the disturbing trend is just too much of reaction to everything, because it's in your face, either on TV or on Twitter or on WhatsApp or whichever way. I think people need to just relax, think, read, enjoy their life, not agonize over their portfolios on a daily basis.
So the next question is a very interesting question. In each and every sort of Indian family, you'll have an uncle, who's lost money, who's saying that, this is a scam and this is X, Y, and Z. What I want to ask you sort of point blank is, what is the one biggest mistake that you made where you said that, look, I don't know what I did, but I did it. And hopefully there were, 3 learnings from that.
I think I made a lot of mistakes. So, it's very difficult for me to choose the worst one. It's like,
hopefully we don't make them for our clients again, right? So I think that's, and one of my, and I'm just going to interrupt you here. One of my clients, tells me that, Jai, I know you don't have a magic wand, right? I'm just hiring you for, your years of mistakes that you've made and nothing else. That, hopefully you won't make the same mistakes for me. Yeah. But sorry, go on.
Yeah. So I think the mistakes that were made, or where I lost money, were when I did not have any process and I was just picking stocks and getting carried away by, this investment thesis that I created in my own mind, saying that, look, this is going to be, the next big thing, and the management is great, and, balance sheet may be weak, but it's okay. It will correct itself. So this is very cheap. And the focus on that, buying the cheap stocks at the, bottom fishing because they have fallen 90-95% from top, that strategy never worked out, always lost money. And that
Okay.
was one of the turning points to just analyze that why does that happen, and then you realize that historically, if you look at data, only 2% of the companies that have fallen more than 70-80% ever go back to their old prices. So
You paid a significant amount of tuition fees over time.
oh
So,
yeah, all of us pay that. So it's like everybody pays. Some people pay the tuition fee and leave the college or leave the
right.
industry. I just say we paid the tuition fee and stuck around.
Absolutely, absolutely. And on sort of this line of thinking, has there been time in your career where you had to make adjustments to your process, your thinking, your style, and sort of keep your emotional quotient under control more than anything else?
It happens every day. Frankly, even now, I'm a human being. I
Huh.
I look at a stock or I look at a company or I read about something and I get very excited and I go tell my team that let's increase allocation, let's buy this more.
Sure.
And and the good thing is that we have a team, we have a process where we say that and they are very vocal. They don't cut me any slack and they tell me why are we doing this? That's not the strategy. It's not. And
Huh.
and I have to fight that battle emotionally and say, look, but I'm the fund manager. Why are you telling me we can't buy this? Why can't we increase allocation to a particular stock or buy more of Nestle or
Right,
buy?
right,
So,
right.
so I think that's a daily battle that every investor fights and should fight, with himself, not let the bias come in.
What is the one thing or one opportunity that you saw which was quite obvious to you, but the street completely missed it?
Okay, so I'll go back to my first investment that I ever made, and I was in Citibank. It was my first job in 1993, 94.
Okay.
Uh, and I I was very young. I think I was 23 years old, and I joined Citibank out of college, out of MBA school, and the country head of Citibank, an American that time, he called me and said, "Look, we are setting up this fund, $50 million on balance sheet. You run it."
Sure.
And I mean, it was a big responsibility. And then the second thing he said that, look, that is the easy part. The tough part is that you can't lose any money. So because we are a bank, we can lose money. So
Sure.
luckily for me, what happened is around that time, there is this company, there's a bank that came out with this IPO, and that bank was HDFC Bank.
Okay.
Uh, so when I looked at the IPO, I met some of the team members, and I said, look, forget $50 million that you have given me. Let's put $100 million into this. We're not going to get allocation anyways, but let's do it.
Right. Right.
And so we put up money, we made money, and then I left Citibank in '98. I joined what was then India's primary private equity fund,
Sure.
uh, uh, and then there also I put almost half of the fund's capital into HDFC Bank stock because that time NatWest was exiting the bank in '98, '99,
Right.
and we were like literally the stock was on fire sale basis. Our management committee in New York said that it is the most expensive bank in the world. It's trading at 4.5 times book value. We trade at 1.5 times book value. Why should we buy it? So we had a lot of fight, and they cut down the allocation.
Sure.
NatWest was selling 15%. I wanted to buy entire 15%. We got to buy only 7.5%. That
Okay.
$50 million investment returned $600 million for us in 6 years' time. So I
Sure.
think
Okay.
that is a story that was open to everybody from day one, from the day the bank came out with this IPO.
Sure.
And very few people actually loaded up on it and said, "This is one stock I own. It will be this." And even now, this is a stock from 2000. If you some before the correction, I saw that the CAGR, the IRR of HDFC Bank from 2000 is 23%. So if
Right.
you do nothing, just own that one bank, you know.
Sure.
So it's a great story. It's for everybody to see, but I don't understand why people keep missing it all the time.
That question, where do you think the next sort of avenue for alpha lies in terms of a risk adjusted return for the next 5 years? Is it in large cap, mid cap, small cap, have a multi cap portfolio, or something else that you want to say?
So my favorite space is to look for companies which are large in size, because that largeness brings some stability to the business and de-risks the
Okay.
business, especially in their ability to attract and hire talent and groom talent and have good HR processes. But larger cap companies that behave like, dynamic companies, young companies that are ready to innovate, ready to take risks, that are not becoming bureaucratic, uh, and have professional management. Though I think that's where the big alpha will be generated. And I'm telling you, one very interesting thing that you can watch out for is companies that are adapting to the digital models more aggressively than others. So insurance companies, for that matter, look at any of the insurance company like HDFC Life or
Right.
ICICI Lombard. They're all running what they call virtual, uh, you know, uh, virtual offices. ICICI
Okay.
Lombard does it for that instance. They
Correct.
don't have a physical office. The customer thinks there is an office, but there is no office.
If I could push you for two names.
So one I said is insurance. I think insurance companies are doing that very well, and I think I mean, even a company like InfoEdge, for that matter, which has a lot of consumer internet portals.
Okay.
I would say, yeah, these are the two names that come top of my mind.
I think we're almost at the end of this. One of the things that I like to end it with is you've been in this business for upwards of 25 years, right? But there might be a lot of people who've just started taking on client money, and maybe in Jan of 2020, right? What is the one advice or two, three pieces of advice that you'd give to them? I think that look, it is what it is, but
Yeah, I think one thing that I've learned is that not to take too much of advice or pressure from the clients. They give you the money because they like your strategy. A lot of them would come and tell you, give you advice on what to do, not to do. They will panic, they will act like retail investor, they'll try to influence your thinking. Don't fall into that trap. Might as well not be managing other people's money. So whether you like it or not, there will be pressure from your investors, but deal with that pressure in a very sensible manner. Don't bow down to that pressure and do something which is not consistent with your strategy.
and before we end this, anything that you'd like to add, Abhay?
No, look, I really enjoyed talking to you guys. Yeah, I enjoyed this interview. I think this was more fun than any webinar that I've done. So thank you
Excellent.
very much, and keep up the good work.
Perfect. Thank you so much for your time, Abhay. It's great that you guys take out this time during such trying times, and obviously COVID has made it a bit easier to catch you folk and do webinars such as this. But again, thank you for your time, and
Sure.
we'll be in touch.
Yeah.